In today's show, we will be explaining the eligibility requirements for contributing to a traditional and Roth IRA, cover contribution limits, deadlines, and discuss the benefits of making an IRA contribution. Before we get started, make sure you have a copy of the video training workbook. This workbook will provide you with reference material and exercises to reinforce the concepts discussed in today's show. Now, please welcome our host, Chad Newman.
Hello, and welcome to IRA Contributions. I'm here with Paul Kern, the Manager of Instruction with the Census, who will be answering our questions about IRA contributions. Hi, Paul.
Hi, Chad. Thanks for having me. Let's get started.
Great. I guess the first question I should ask is, who can contribute to an IRA?
Surprisingly, Chad, most people are actually eligible to contribute to an IRA. Specifically, there are two requirements to contribute. The first requirement is that you need to have earned income.
Okay. What is earned income?
For IRA contribution purposes, earned income, also called compensation, generally is income that a person earns from working.
You said income generally earned from working. Could you clarify what that means?
The IRS established a safe harbor definition of compensation. IRA owners can rely on compensation as shown in the Wages, Tips, Other Compensation box on Form W-2, Wage and Tax Statement, reduced by any amount shown in the Non-Qualified Plans box as income for determining an IRA contribution.
So IRA owners can easily check Form W-2 to verify eligible earned income for IRA contribution purposes.
That is correct.
A list of the types of income that are considered compensation for IRA contribution purposes and those that are not is included in your video training workbook. If I have earned income and income that is not considered earned income, how do I determine if I can contribute?
If you have both eligible and ineligible earned income, you do not have to place the eligible income itself into an IRA. But most have eligible income to support an IRA contribution.
So my salary is considered eligible income, and my stock dividends are not considered eligible income. Does that mean that I can make a contribution with money from either source?
Whether the actual assets going into the IRA come from the eligible or the ineligible income source is irrelevant, because you have eligible income to support a contribution.
Okay, so if all I had was dividends, then I wouldn't be eligible to contribute.
Correct. If you only have ineligible income, you cannot contribute to an IRA because you do not have eligible income to support a contribution.
So it seems like it is really my issue, not the issue of the financial organization.
Yes. While it is important for the financial organization to know what eligible income is, the financial organization does not make this determination. Instead, IRA owners should consult with their own competent tax advisors to make a determination regarding compensation for IRA contribution purposes.
Great. Let's do a quick review. Turn to Exercise 1 in your video training workbook. Go ahead and pause the DVD. When you are ready to check your answers, push play, and Paul will let you know if you are correct.
Let's take a look at the answers for Exercise 1. In the Earned Income column, we would have the following: bonuses, commissions, professional fees, salaries, tips, and wages. In the Not Earned Income column, we would have the following: disability pay, dividends, interest, rental income, Social Security, and unemployment compensation. If you had any challenges with this exercise, please go back and review the Introduction to Contribution section before you move on.
Paul, earlier you said there were two requirements to be eligible to contribute. In addition to earned income, what is the other requirement?
For a traditional IRA, the other requirement is that the IRA owner must be under age 70 and a half.
Does that mean that when I reach age 70 and a half, I can no longer contribute to a traditional IRA?
Not exactly. What it really means is that you can't contribute in the year you reach age 70 and a half.
So if I turn 70 and a half next year, that would mean that I can contribute for this year, but then I'm no longer eligible for future year contributions?
Correct, because 70 and a half means exactly 6 months after your 70th birthday.
So if I was born January through June, I would turn 70 and a half in the same year I turned 70.
Correct. And if you were born July through December, you would turn 70 and a half in the year after you turn 70. So you would get one more year to contribute.
In your video training workbook, you will see a chart to help you determine when an IRA owner would turn age 70 and a half.
To use the chart, you need to know the IRA owner's birth date. Then add 70 to the birth year if they were born between January and June, and 71 to the birth year if they were born between July and December.
So this gives me the first year I am no longer eligible to contribute?
Correct.
Is there a minimum age for being eligible to contribute?
From a federal tax law standpoint, there are no restrictions on the minimum age of an IRA owner. However, when individuals establish IRAs, they are entering into a contract with the financial organization. In most states, there are restrictions on the ability of minors to enter into a valid contract. A financial organization should meet with its attorney and establish procedures regarding minors establishing IRAs.
Now, what about the other eligibility requirement for Roth IRAs?
As with traditional IRAs, an individual must have earned income to make a Roth IRA contribution. There is no age limit for making contributions. However, the individual must have earned income that cannot exceed certain government-defined limits.
What type of government-defined limits?
Contribution eligibility for a Roth IRA depends on the taxpayer's modified adjusted gross income, or MAGI, and income tax filing status.
Your video training workbook contains a copy of the MAGI chart for determining Roth IRA eligibility.
As you can see on the chart, if you're an IRA owner filing as a single filer, you can make a full contribution as long as your MAGI is less than the amount in the first column.
What happens if my MAGI is more than the amount in the first column?
Then the amount you can contribute decreases until you reach the amount in the last column, at which point you are no longer eligible to contribute.
So if my MAGI is less than the amount in the first column, I can contribute the full allowable amount. If my MAGI is more than the last column, I can't contribute at all. And if I am somewhere in between, I can contribute, just not the full amount.
Correct. And if you are married filing jointly or separately, the same concepts apply. You would just need to look at the appropriate values.
Great. Let's do a quick review. Turn to Exercise 2 in your video training workbook. Go ahead and pause the DVD. When you are ready to check your answers, push play, and Paul will let you know if you are correct.
Let's take a look at the answers for Exercise 2. Question 1, yes. Opie can contribute to a traditional IRA because he has earned income and he is under age 70 and a half. Question 2, no. Howard cannot contribute to a traditional IRA. Even though he has earned income, he is over age 70 and a half. Question 3, no. Floyd cannot contribute to a traditional IRA because he does not have earned income. Question 4, yes. Helen can contribute to a Roth IRA because she has earned income and she is under the MAGI limit for a single income tax filer. Question 5, no. Emmett cannot contribute to a Roth IRA because even though he has earned income, his MAGI is above the limit for a single income tax filer. Question 6, no. Floyd cannot contribute to a Roth IRA because he does not have earned income. If you had any challenges with the exercise, please go back and review the contribution eligibility section before you move on.
Now I understand if I am eligible to contribute or not contribute. As you discussed in eligibility, you mentioned a full contribution amount. What would that be?
The IRS defines those limits each year based on cost of living adjustments, or COLAs. The COLAs only apply to the regular contribution amount.
The contribution limits chart is listed in your video training workbook.
As you can see, the amount an IRA owner can contribute is based on the age of the IRA owner. If the IRA owner is under age 50, the IRA owner can contribute the amount listed in your book.
All right. What if I am age 50 or older?
Individuals who are eligible to make regular contributions and who are age 50 and older before the close of the taxable year may make additional catch-up contributions up to $1,000. The catch-up contribution amount is not based on COLAs.
So does that mean if I turn 50 on December 31st of this year, I could come into the financial organization anytime during this year and would be eligible to make the catch-up contribution?
Exactly. The date you turn age 50 isn't important. It is the year you turn age 50.
Next year, when I turn 51, can I also make the catch-up contribution?
Yes, the catch-up contribution applies to any eligible individual who is age 50 or older.
Paul, earlier you also mentioned that to be eligible to make a contribution, I had to have earned income to support the contribution. Could you explain that further?
For example, if you only have $3,000 of earned income, that would be your maximum contribution, even though the IRS limit is higher.
Okay, so if I had earned income of $30,000, I could contribute the full contribution limit to my IRA because my earned income is above the IRS limit, assuming I meet the other eligibility requirements.
Correct.
In the same situation, would that also mean that I could contribute the full contribution limit to both a traditional and a Roth IRA if I wanted to?
Unfortunately, Chad, the contribution limit is an aggregate total. This means that no matter how many IRAs you have, you are limited to the annual contribution limit. But you could divide this amount across multiple IRAs.
Great. Let's do another review. Turn to exercise 3 in your video training workbook. Go ahead and pause the DVD. When you are ready to check your answers, push play and Paul will let you know if you are correct.
Let's take a look at the answers for exercise 3. Question 1, B. Opie is under age 50, therefore he can contribute the full annual contribution limit. Question 2, A. Floyd cannot make a contribution because he has no earned income. Question 3, C. Helen can make a full contribution, and because she is over age 50, she is also eligible to make a catch-up contribution. If you had any challenges with the exercise, please go back and review the contribution limit section before you move on.
So, I can only contribute up to the IRS limit, but I have this $30,000 in earned income. Now, my wife stays at home with the kids and does not have any earned income. Can I make a contribution on her behalf?
What you are talking about is a spousal contribution. This option simply allows a working, wage-earning spouse, yourself, to fund an IRA for the other spouse, your wife, who individually may have little or no earnings.
So I could make a contribution based on my earned income on her behalf?
Yes. The key point to remember here is that spousal contributions really are the exact same as regular contributions. The IRS does not care who writes the check and makes the contribution.
Are there any limitations about using the spousal contribution rule?
Yes. You and your spouse must file a joint income tax return, and each of you must have your own IRA to receive the contribution.
So if my wife and I both have our own IRA, and we file a joint income tax return, we can use my earned income to make a contribution to my IRA and to her IRA because my earned income exceeds the limit for both IRAs.
Correct. You always need to have enough earned income to support the contribution.
Let's do another review. Turn to exercise 4 in your video training workbook. Go ahead and pause the DVD. When you are ready to check your answers, push play, and Paul will let you know if you are correct.
Let's take a look at the answers for exercise 4. Question 1, C. Briscoe is over age 50, so he can make a full contribution and also make a catch-up contribution. Question 2, B. Even though Ellie does not have earned income, she is married to a spouse who has earned income, and their joint income allows for a full contribution. Question 3, A. Remember, the contribution limit is an aggregate total, and if Briscoe and Ellie each make a full contribution to their own traditional IRA, there would be no amount left to make a Roth IRA contribution. If you had any challenges with the exercise, please go back and review the spousal contribution section before you move on.
Okay, so I know if I am eligible and how much I can contribute. Is there a deadline for making the contribution?
Yes, the deadline to make a contribution for the year is that year's tax return deadline, usually April 15th.
So if I want to contribute for this year, I have until April 15th of next year to make the contribution.
Correct. Unless April 15th falls on a Saturday, Sunday, or legal holiday, then the deadline would be the next business day.
So what you were saying is that I could come into the financial organization in February and make a contribution for last year?
Yes, you could. This is called a prior year contribution.
Is there anything special I need to know about making a prior year contribution?
Yes, the IRS requires the irrevocable prior year contribution to be made in writing. Many financial organizations use a contribution form supplied by a forms vendor, such as a census.
What happens if I mail in a prior year contribution?
To be a valid contribution for the prior year, it would need to be postmarked by the deadline and in writing.
Okay, what happens if in February I want to contribute for the current year rather than a prior year?
There is no written documentation requirement. However, many financial organizations will still use a contribution form due to the fact that contributions are reported to the IRS.
Let's do another review. Turn to exercise 5 in your video training workbook. Go ahead and pause the DVD. When you are ready to check your answers, push play, and Paul will let you know if you are correct.
Let's take a look at the answers for exercise 5. Question 1, C. Because the date is before the tax return deadline, OP is eligible to contribute for the current year and the prior year. Question 2, A. The requirement only states that irrevocable contributions for the prior year must be in writing, although your financial organization may require written direction on all contributions. Question 3, A. A contribution is considered timely if it is postmarked by the deadline and includes written direction. If you had any challenges with the exercise, please go back and review the contribution deadline section before you move on.
Okay, we know who can contribute, how much can be contributed, and when the contribution must be made. So I guess my next question is, why would I contribute to an IRA?
The easy answer is that you can use the IRA to save for retirement, because after you make the contribution, your earnings will grow tax deferred.
What do you mean tax deferred?
Tax deferred means that you will not pay taxes on your earnings while the account is growing.
Great. Are there any other benefits to contributing?
Yes. Certain lower income individuals may receive a non-refundable tax credit not to exceed $1,000 for contributions to traditional or Roth IRAs.
I assume the IRS has some requirements regarding an IRA owner's ability to take the non-refundable tax credit?
To be eligible for the tax credit, the individual must attain age 18 before the end of the taxable year, must not be claimed as a dependent, must not be a full-time student, and must have adjusted gross income within the limits.
A list of these requirements and the non-refundable tax credit chart are in your video training workbook.
As you can see on the chart, the tax credit is based on the adjusted gross income and filing status of the IRA owner. Eligible individuals determine their credit by multiplying the applicable percentage by their traditional or Roth IRA contributions that do not exceed $2,000. Remember, the maximum credit is $1,000.
Would a financial organization be responsible for this calculation?
No, the non-refundable tax credit is the responsibility of the IRA owner and their skilled tax advisor when completing the IRA owner's tax return.
Are there any other advantages to making an IRA contribution?
There is one more advantage to making a contribution, but it only applies to the traditional IRA. This is the opportunity for an IRA owner to deduct contributions made to their traditional IRA on their tax returns.
So if I have a traditional IRA, I can take a tax deduction?
Possibly, but do not confuse deductibility with eligibility. As we have discussed, almost anyone is eligible to contribute to a traditional IRA, but whether that contribution is deductible is another matter.
Then how do I know if I can take a deduction?
Whether a contribution or a portion of a contribution is deductible depends on active participation in an eligible employer-sponsored retirement plan, marital status, and MAGI based on the IRS Form 1040 U.S. Individual Income Tax Return.
What do you mean active participation?
An IRA owner is considered an active participant if he is a participant in one of the employer-sponsored retirement plans for any part of the applicable tax year.
A list of the employer-sponsored retirement plans can be found in your video training workbook.
Simply put, individuals generally are considered active participants if their employers or union has a retirement plan under which money is added to these accounts on their behalf.
Is there an easy way for an IRA owner to know if he is an active participant?
Form W-2 contains a checkbox entitled Retirement Plans. If it's checked, the taxpayer is considered an active participant.
Okay, so if I'm an active participant, then I can deduct my traditional IRA contributions?
Actually, active participation is only the first part of the puzzle. You will also need to look at your marital status and MAGI.
In your video training workbook, you will see a flowchart that explains the relationship between the three elements for deductibility, along with a definition of MAGI.
As you look at the flowchart, you can see that first we determine if the individual is an active participant. If the answer is no, we also need to determine if the spouse is an active participant. If neither the IRA owner or their spouse is an active participant, then you will see that the IRA owner can take a full deduction of their traditional IRA contribution. MAGI isn't important.
So if I am married and neither my wife nor I are an active participant, can we both fully deduct our traditional IRA contributions?
That is correct. And if you were a single filer and not an active participant, you would also be able to take a full deduction.
That sounds easy enough. What happens if either my wife or myself is an active participant?
In that situation, you would need to look at your MAGI, which is again defined in the video training workbook, to determine if you are eligible to take a full deduction, a partial deduction, or no deduction at all.
In your video training workbook, you will see an MAGI chart that explains the limits for deducting an IRA contribution. Paul, could you give us an example of how this works?
Sure. As you can see, if you are a single filer and an active participant, you have an MAGI phase-out range. If your MAGI is below that range, you can take a full deduction. If you are above that range, you can't take a deduction at all. And if you fall in the middle, you can deduct a portion of your traditional IRA contribution.
What happens if I am married filing a joint tax return?
The same calculation would apply. You would just use different parts of the chart. You would need to look at your contribution and your wife's contribution separately for determining the deductibility.
Why do I need to look at each of us separately?
If the IRA owner is not an active participant, but is married to an active participant, you will see in the chart that the phase-out range is different than if the IRA owner is the active participant.
Making these calculations seems like a lot for the financial organization to handle.
The financial organization is not responsible for determining if the IRA owner can actually take the deduction. This would be between the IRA owner and their skilled tax advisor. Although understanding how deductibility works can help you explain this benefit to the IRA owner.
All right, time for a quick review. Turn to exercise 6 in your video training workbook. Go ahead and pause the DVD. When you are ready to check your answers, push play, and Paul will let you know if you are correct.
Let's take a look at the answers for exercise 6. Question 1, no. Because Mary is an active participant in an employer-sponsored retirement plan, her MAGI is above the limit for a single filer to take a deduction on her traditional IRA contribution. Question 2, yes. Because Jim is a single filer and is not an active participant, he is eligible to take a full deduction of his IRA contribution. Question 3, no. Because Mary is an active participant in an employer-sponsored retirement plan, her MAGI is above the limit for a joint filer to take a deduction on her traditional IRA contribution. Question 4, no. Because Jim is married to an active participant, he must look at the MAGI chart, and his joint income with Mary is above the MAGI limit to take a deduction. If you had any challenges with the exercise, please go back and review the contribution benefit section at this time.
Paul, you have done a great job explaining why I would contribute, when to contribute, and how much I can contribute. Based on other discussions we have had, I would assume that there is some type of reporting we would need to take care of?
Yes, financial organizations need to report all contributions to the IRA owner and to the IRS.
How would I handle that reporting?
The first step is to make sure you have the information needed to complete the reporting. Earlier, we discussed how the IRA owner would document the contribution on a form for the financial organization. These forms are used to gather the information needed to report to the IRA owner and the IRS.
If the financial organization has all of this documentation, what do they do with the information?
The information is reported to the IRA owner on an account statement. The IRA owner would receive a separate statement for each IRA she owns, which would include all contributions to that type of IRA.
So if I had a traditional and a Roth IRA, I would receive a separate account statement for each type of IRA.
Yes, each IRA would have its own statement.
Would I use this same method to report to the IRS?
While the method would be the same, you would use IRS Form 5498, IRA contribution information, to submit the information to the IRS. Although many financial organizations use the Form 5498 to report to the IRA owner as well.
Okay, so I can use the Form 5498 to report to the IRS and to the IRA owner. When would that need to be sent?
Yes, you can use the Form 5498 to complete the reporting, which must be postmarked to the IRA owner and the IRS by May 31st of the year after the contribution was attributed.
Thanks, Paul. For more information about the specifics of reporting contributions, see our episode on IRA reporting. Time for one last review. Turn to Exercise 7 in your video training workbook. Go ahead and pause the DVD. When you are ready to check your answers, push play, and Paul will let you know if you are correct.
Here are the answers for Exercise 7. Question 1, C. The deadline to report contributions to the IRS is May 31st. Question 2, C. The deadline to report contributions to the IRA owner is May 31st. Question 3, B. Because Opie contributed to both IRA types, he would need to receive an account statement for each IRA type. If you had any challenges with the exercise, please go back and review the contribution reporting section before you move on.
I would like to thank our guest, Paul Kern, for helping to cover the basics of IRA contributions. Your understanding of contribution limits, deadlines, benefits, and reporting will assist you in answering IRA owner questions. This will benefit your financial organization as you develop relationships with IRA owners and continue to assist them in answering basic questions about their IRAs.
Thank you for watching IRA Contributions. We hope you've enjoyed learning the details about IRA contributions and that you now have a better idea of what you need to know and what is helpful for you to know. Using your new knowledge of IRA contributions, complete the case study found in the back of the video training workbook.